As your creative agency grows past the $500,000 or the $1 million mark, taxes become one of your biggest expenses, of course. And while logically and rightly so, one of the most widely shared and favorite ways to reduce tax is by investing into a retirement plan. But if your retirement plan is still the SEP IRA or the solo 401k, I hate to be that guy, but you're choosing the wrong plan for your marketing, for your creative agency. This can cost you tens of thousands in unnecessary contributions, fees, and unnecessary annual compliance costs. So today I'm going to break down why SEP IRAs don't work for real agencies, why solo 401ks stop making sense, what the best retirement account for your agency is, of course, and lastly, before you jump to it, when you should not make the switch. I'm Jose Cardenas, CPA and enrolled agent at Westfront Tax and Accounting, where we provide business accounting, weekly bookkeeping, and tax planning to growing service businesses. What most creative agency owners don't realize is that most retirement plans are built for you and for you only, because most people with a business are solopreneurs. They are the only owners, the only operators. And look, I understand that's how we all start. But as your agency grows and you're past the $500,000, the 1 million, you now have a team, things begin to change. You have a way larger tax exposure, you have payroll to maintain, all while keeping your agency most profitable and making sure you don't overspend the cash you have on hand, of course. So we have way more variables to consider when choosing the best retirement account for your agency, given at the stage that is in now with a team. And we're going to go through why each of the most retirement accounts, the most widely shared retirement accounts out there, don't work for your agency. The first one, SEP IRAs, they're great, fantastic when you're starting a business for solopreneurs and businesses that have no W-2 employees. They're simple to set up and you can contribute up to 25% of your officer's salary, up to a certain annual limit, of course, that changes every year. But here's the caveat. Once your agency is doing real numbers and you start hiring employees, you get absolutely burned by the requirement that whatever percentage you contribute to yourself, you must contribute the same percentage for every single eligible employee. For example, if you have a $100,000 officer salary that you pay yourself and you want to contribute 25% of your salary to your SEP plan, you now have to contribute the same 25% to your employees' SEP plan based on whatever it is that you pay them in salary. So for example, if you have $500,000 in annual payroll, that's $125,000 in contributions that you need to come about out of pocket if you want to be able to contribute the $25,000 in your own SEP plan. That is, in total, that's $150,000 in contributions in 1 year, okay? And these contributions, they are based on W-2 salary. So even if you're experiencing little to no profits, maybe you're going through a hard time, a tough time of the year, you're still on the hook for this requirement if you want to be able to contribute to your own SEP plan as an officer. And hey, unfortunately, look, many learn this the hard way. The next big guy is the solo 401k, one of the best retirement vehicles out there. But just like the name implies, you can't keep a solo 401k open once you hire full-time employees. And so you're basically forced into a full 401k structure. And at that point, you're now stuck having to deal with annual discrimination requirements. In other words, that's a fairness test that the IRS imposes against highly compensated employees. For example, you as an officer, a great example. And what this means is that come year end, the IRS compares what owners contribute as a percentage of pay versus what was contributed for employees to determine if there's a big discrepancy as a percentage of pay between the two groups. For example, if your team averages 3% in contributions as a percentage of their pay in a given year, you cannot just, as an officer, contribute 25% of your salary towards your own 401k and just move on. If you do, what happens is that the IRS checks after year end, and if whatever there's a discrepancy for, you get a refund and it becomes taxable income to you. However, this is when the safe harbor 401k comes into play, okay? Hands down, the best retirement account for agencies that are past the half a mil, 1 million, $2 million mark, and now have employees, they have a team to maintain and to take care of. And here's why. Contrary to the normal 401k, with the safe harbor 401k, you can avoid the fairness test. And what this means is that you can max out as an officer, as a highly compensated employee, you can max out your contributions and not have to worry about any refunds because your team or you didn't contribute enough to your employees, to your team's plan. Because although you cannot get rid of the fairness requirement completely, you can at least control the percentage. So instead of having to match your 25% of contributions, for example, with doing 25% for all of your employees in salaries based on what you pay them in salaries, you can at least control that matching percentage contribution to 3% or even 4% of whatever it is that you pay them in salary. These characteristics are what makes a safe harbor 401k plan predictable, manageable, and most importantly, scalable, okay? Because as your agency further grows, I'm sure that you'll be looking to hire more people to timely fulfill because you have more clients. But more importantly, this is what having a real agency looks like, a real company. And look, the best agencies, the best businesses have the best talent. And having a structured 401k signals stability and long-term thinking. Also, because of its predictable nature, it makes it easier for you to offer competitive salary and bonus packages. Very, very attractive things to have if you want the best people to want to work for you, want to work for your agency, for your business, because I'm telling you, talent competition is very, very real. But there's more. It can be more. The ball does not have to stop with the safe harbor 401k. If profits allow it, of course, you can even get into a profit sharing plan because, and I know, turnover, very, very expensive. And this is a fantastic way for you to incentivize both loyalty and retention, or even get into a cash benefit plan if you want on top of it all. But look, my point is that as you scale, like this is how you scale your retirement plan, your retirement planning as your agency grows. Not so fast. Don't go and pull the trigger on a 401k, on a safe harbor 401k just yet, just because you now know that it's the best retirement vehicle for your growing agency. We have to be very responsible with it. We have to take a step back and also consider the circumstances around your business. So some of the things that I would consider are, hey, is your revenue volatile? Are you aggressively reinvesting every single dollar into growth? Are you in a hyper growth stage? Is your cash flow tight? Is your headcount unstable? These are some of the things that you should consider because one way or another, the safe harbor 401k does require, to a much lesser extent, yes, than its counterparts, it still requires employer contributions after all. And we want to make sure that you're in a good position, in a good cash position today and moving forward, and not just chase deductions, okay? This is how you can sustainably support and prioritize your retirement plan strategy for you and for your team, of course. So if any of these risk factors apply to you, to your agency, I have to be honest, but I would say that you're better off going with a much simpler option, a much simpler route, at the very least in the short term, and that's with a personal IRA. Every year the contribution limit changes, but as of 2026, for example, the recording of this video, you can contribute up to $7,500 a year per person if you're under 50. If you're over 50, you get a nice little bump of an extra $1,100. That, by the way, you can make the contributions up until April 15th of the following year, not December 31st, okay? So for example, it's 2026, you have until April 15th of 2027 to max out your contributions. And look, I'm a strong advocate for making it a Roth, but even if you can't because maybe your income is too high, you can still manage to work around this easily and contribute to your Roth every single year by just using a backdoor strategy. And look, whichever you end up going with, keep in mind that choosing the right retirement plan for your agency, for your business, not only comes down to making sure you pick the right vehicle, but also by considering the implementation as well, because owners often take large distributions, ignore structured investing, or assume they'll just sell the agency for 8x someday in the future. That, by the way, I have made a video about that already. But the retirement plan should smoothly integrate with your officer compensation, your profit margins, and ideally to your hiring roadmap as well as you grow. Because this is a look, this is how you build wealth on purpose. Don't treat the retirement plan, don't treat your retirement plan investing as just a tax move. Look at it as a generational wealth strategy. So if your agency is making over half a mil, 1 million, $2 million a year, and your retirement plan maybe has not evolved since your solopreneur days, guess what? You're now in a position to restructure it properly, to match the size, match the complexities that your agency now has for you to sustainably grow and build wealth. And if you're serious about building your agency like an asset, not just an income stream, hey, look, accounting is way more than tax. We gotta use the numbers to actually run a smarter business. So make sure you follow the channel, subscribe to the channel, smash the like button for me. And with that said, I'll see you on the next one.